After selling off hard today, the Dow came back up toward the top end of its trading range, creating a hammer type signal. This does not necessarily mean the downtrend is over, but it now puts the prospects of being able to watch to see what they do with this market tomorrow. If they open up positive, more than likely they're coming back up to test the T-line. If they open it lower, still a good prospect they're taking it down because our stochastics aren't in the overbought condition. In the oversold condition. After the very obvious shooting star signal that failed right at the 50-day moving average on the NASDAQ, today's trading still as indecisive as the previous trading, but after trading down quite a bit, it closed back up. Not only didn't close positive, but as you can see, it closed above where it opened, meaning there was buyers coming into this index going into the close. This still puts the same emphasis on how the market opens. If it opens positive, it could have a couple of days of bounce into the back up to the T-line. A lower open, you continue to hold or look for short positioning. Knowing the simple rules of the Japanese race traders that if you see a gap down in the oversold condition, start looking for a potential reversal signal. Well, they gapped down things like AMBA today, where it traded down. But when it came back up through today's open, in the oversold area, there was a good possibility that it could create some sort of candlestick buy signal, or at least it told you the bulls were stepping in. So that becomes a very good spot to start taking your profits on your short positions. The same scenario would be on a position like short being blue, B-L-U-E. When it started coming back up toward the top of the range, forming a hammer signal, getting close to the oversold area, the whole point of being or using candlestick analysis is to see what's going on in investor sentiment. When we can see that they're starting to trade positive in the oversold area and starting to come back and doing a potential reversal signal, that tells us either we lighten up on the short position or close out the position. If it opens lower, you can always re-short it. Identifying long positions in a sloppy market becomes much more easily when using candlestick analysis. Notice how MPO was trading positive all day long, kind of breaking this wedge formation, telling us that they couldn't close below the T-line, and there's kind of a little slow curve here, making the next potential target the 200-day moving average. So anytime you can identify a Western pattern or any pattern like the wedge, and it breaks out because of a candlestick buy signal, puts you in a position where your probabilities of being in the right place at the right time is that much greater. That'll be it. We'll see you in the chat rooms.